How's it going, everybody? This is Beat the Bush. Today, I'm going to talk about why I don't invest in peer-to-peer lending and why you shouldn't either. Peer-to-peer lending started cropping up sometime in 2006 from companies like Lending Club or Prosper. There's various other ones that does the same thing. The claim to fame with these companies is that it promises that you are peer-to-peer lending, where you have a whole bunch of investors, not banks or anything, just regular people that has some money that you want to invest. And then you're funding a particular person that needs to borrow money. So these peer-to-peer companies can say, oh, we don't have a bank involved, so we can charge the borrower a little bit less interest, and we also can give the investor a little bit more. So this is kind of like undercutting the bank, cutting out the middleman, so then they can charge everyone less. The strange thing about these companies is that they're owned more and more by big banks because they have a larger and larger investment in these actual companies. So you can kind of say the big banks aren't involved or anymore, but they are. They are financially invested in these peer-to-peer lending platforms. Now what they tell you to do in these lending clubs is that you got a bunch of money in there and they want you to disperse it a little between a lot of different loans. That in effect says, okay, it's kind of reducing your liability for each particular loan. So it's kind of like diversification, kind of. So I pulled up some statistics, just general knowledge. 2015, they have a default rate of about 3.3%. Your returns can vary anywhere from 6 to 9%. And it varies because you can actually go in there and choose which loan you want to fund in increments of $25 or something like that. So you can put very little in each one, and then you can just kind of like blanket everything and hope that you pick the good ones, or just from the description, from the credit score, that the borrower is going to make good on repaying you. The borrowers have something like 3 to 5 year term in which they have a solid payment they have to make every single month. Their interest rate varies depending on their credit score. You can kind of think of this as lending $10,000 to someone. It's not one single person, but let's just think of it as one person for now. There's a certain interest rate they're going to pay you, and they're gonna pay you back within 3 to 5 years, okay? So they're gonna make monthly payments to you. Once your $10,000 is invested, you cannot access that. You can't just one day say, hey, give me all my money back, I really need it. No, you can't do that. Your money is locked in until they slowly pay it all back to you. As a person with limited capital, that's really restraining, because what if 3 to 5 years later, you need some money to do whatever. You need to buy a car or something. Some emergency happens, but you can't really withdraw that. So liquidity is a huge issue here. Let's say you are investing $10,000 in Lending Club, and once you go into their platform, you can invest in many different borrowers. You can split them up however you want. You can choose whichever you want. So what happens is, let's just say we aggregate all these borrowers into one just to make it simple. So the borrower here applies for a loan and they get a certain interest rate depending on their credit score. But once it gets funded, Lending Club actually takes a percentage of that, anywhere from 1.11% to 5% away before they get the rest of the money. So if they apply for $10,000, you're not gonna get the full $10,000. You're gonna get a fee removed from it, and Lending Club gets to pocket that. Wow, this is great. I really would like to be Lending Club myself, because you just sit here on the sideline. You don't have any of the risk because you got the investor here that gives money to the borrower to borrow. You're just here collecting fees and you don't have any risk. On top of that, when the borrower is paying you back, okay, we estimate maybe, let's say it's a 3-year loan, 10%, and then every single month is about $320. When the payment comes in, they also take a little cut right here in terms of a fee. So $3 every single month, they get recurring revenue, and then the rest goes to you. Historically, after you take into account the default rate, okay, you're going to make somewhere between 6 to 9%. But this is dependent on the current default rate. We know that this is a variable, okay? Let's say the economy tanks, people lose their jobs, unemployment goes up, you know, it happens once in a while. And this can happen anywhere between 3 to 5 years, the time frame of this loan here, because you have to wait that long. Okay, if something bad happens within this time frame, the default rate goes up, it can completely wipe out your gains of 6 to 9% on average. So there's a very, very inherent risk in lending money yourself to a person, even if you disperse the risk across many borrowers. When I first looked at the website, I was about to invest in it. I even got an account and I was about to fund it. But I stopped short of that because I didn't like borrowing money to separate borrowers myself. That's just the level of risk I like to take. I don't like to take that much risk and have my capital being illiquid like this, because it's a long outlay, 3 to 5 years. It's kind of longer than like a 1-year CD. Except CDs are quite different because you don't get payments, you just get something right at the end. There's another layer of risk here that is completely transparent, and you cannot really see this when you sign up as a user of this. That is because whenever you fund something, okay, you're actually buying securities in Lending Club, okay? Not their stock, really, but securities in it that varies depending on what you invest in, okay? So every single person that does this is gonna get a different form of the security based on the loans that you're funding. And so this security is a Lending Club security, okay? They are obligated to pay you, okay, if anything goes wrong. And so these securities are repackaged. So it kind of sounds like those subprime mortgage crisis things, you know, whenever you repackage securities and make it so complex. This is hard for me to understand. It's like they juggle it around. And so the next layer of risk here that I'm sure many investors are not taking into account is if Lending Club ever goes bankrupt, okay, the borrower is still required to pay Lending Club, okay? They're not required to pay you. So let's say Lending Club goes bankrupt and they cannot pay anybody back. You are immediately out of all your principal, $10,000, all gone, okay? But the borrower here, it could be across many borrowers, they still have to pay Lending Club. So you essentially become a, you know, like a second class citizen here. You get paid the last if anything goes wrong with the Lending Club. So that kind of sucks because you're already taking the risk of them defaulting, okay? If they default these days without pulling Lending Club under, okay, you get less of a return already. But on top of that, if Lending Club ever becomes insolvent, they are a company, okay? And they can go bankrupt. If they ever go bankrupt, all this money outlay that you did is all gone. You cannot get paid back for that. So you put $10,000 in and you're just looking at the watch, 3 to 5 years, okay? You're just waiting 3 to 5 years and you're counting on Lending Club being in business, okay? If at any time between those 3 to 5 years, they become insolvent, you are out of your initial principal, which is a huge loss compared to the 6 to 9% you get per year. And this in itself makes the risk even higher than buying multiple pieces of stock in actual companies, because you can at least diversify between, you know, 10, 20 companies. Put a lot of money in this. You're actually investing in one single company. On top of this, there's other crazy things happening, like the CEO owns a bunch of investment that the company actually bought so that the investment would go up, right? Normally you're supposed to disclose this. And so there's a conflict of interest, and so I think he got fired or something, and the stock price kept on going down, down, down. Now it's not doing so well, including the people are not investing as much in the platform, which is kind of like the beginning of the end here, you know, like it's like falling down. And if they don't get people to invest, it means they're gonna lose. They're not gonna make as much money, not lose money, but they're gonna make less and less, and it's gonna get closer and closer to being insolvent. I'm not saying they're gonna go down right away, but you know, it could be viable. It could just coast for a really long time and stay solvent. But every single time you invest, okay, you have to wait for the next 3 to 5 years, and you hope that they're gonna stay in business for that duration. And if money comes in like this as payments, you're gonna have more money to invest in, okay? So they have these options where you can either go in there manually to invest in notes, okay? Or you can do it automatically. So if you do it automatically, it means you're just kind of resetting your clock every time it does a reinvestment. You're gonna extend the time at which you can completely pull all your capital out. Where the new money that you invest in is going to have a 3 to 5 year period before you can completely get all your principal back. So I'm quite disturbed by the fact that you can actually lose all the capital. I'm actually emotionally disturbed here. I feel kind of flustered knowing that there's such a product out there that all these people can fall trap into. I hope you watch this video and kind of understand where the risks are, especially for people that are actually invested in it. Don't forget to give me a like over here and comment down below. Let me know if this changed your mind about peer-to-peer lending. And don't forget to subscribe over here. Thanks for watching.